The biggest expense you and I have in our life is taxes. It is the biggest expense. And understanding the tax code, if you neglect the tax code, you pay taxes. If you understand structure and loopholes of the tax code, you build wealth faster because tax savings invested for the long term build zeros and commas faster than just blindly following whatever your CPA says to do on the tax side.
Got it. I'd love to hear more about that.
Yeah. I'd love to. I think you and I are going to have some question and answers, but I did for your audience. There's two things that I'll give to your audience today. The presentation that I do today, I will give it out to anybody who wants it. And then I also wrote a white paper. It's an academic white paper on these same 6 pieces that is also available to you and your audience. But I'd love to share like just some initial thoughts, and then we can have conversation.
Okay, please.
And so again, like taxes are the biggest expense you'll ever have. If an entrepreneur saved $20,000 annually through proper tax planning, invested that money and just got an 8% return, that is almost $1 million over 20 years.
Welcome to Investing for Generational Wealth. My name is John Lai from Clive Capital, where we help high earners just like you invest outside of the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income or cash flow, and tax benefits. Together with you, we're investing in over 1,000 multifamily apartments under renovation, nearly 100 single-family rental homes under development, more than 350,000 square foot of industrial real estate, 700,000 of private loans, nearly 40 oil and gas wells, and we're expanding into other asset classes with the end goal of helping our investors, you, create diversified, balanced portfolios. And before we begin, a quick disclaimer, we're not financial advisors. Our guest is today, but we're not financial advisors. All investments are subject to risks, including the possible loss of the money you invest, so please perform your due diligence before making any financial decisions, and of course, consult your CPA, your attorney before beginning those investments. So again, I'm your host, John Lai, and welcome to today's episode, Tax Strategies for Entrepreneurs to Win, 6 Things to Do Today to Legally Reduce Taxes with Mike Milligan. And Mike is founder of One Oak, One of a Kind Financial. And he's going to share today practical entrepreneurial-focused strategies to legally reduce taxes and keep more of what you earn. He's a certified financial planner, adjunct professor at Old Dominion University, host of multiple financial podcasts and shows, and author of the One of a Kind Financial Plan and Retirement Deja Vu. He's based in San Juan, Puerto Rico, and we'll get into that as well. I'd love to hear a little bit more about that move. Mike continues to help entrepreneurs build wealth strategically while optimizing tax outcomes. And some of the things we'll learn today, 6 smart tax strategies entrepreneurs can apply today, how to avoid those common mistakes that cost your business, and then how to structure your finances for long-term wealth and flexibility. For those who don't know your journey, Mike, could you give our audience a brief history of how you got to where you are today?
Yeah, John, thanks for the invitation to be here with you and your audience today. This is like my passion. I love to educate, but I also implement. Like we have a full-fledged financial planning firm. I began in the industry. I talk about this origin story, and I will not bore your whole audience with this. They can go to my YouTube channel and find out my whole origin story. But after college, I joined some major regional banks. Ended up into what in the financial crisis, what was one of the biggest banks that survived the financial crisis. Then I went and worked at an insurance company, and in 2012, I realized that big Wall Street firms are profit over people. Individual clients' stories got lost in a system. Everybody was reduced to account number, almost like the Matrix, to be honest with you. And like I love dealing with entrepreneurs, but one of the things I always tell entrepreneurs is that you need financial professionals in your life, but if you're dealing with a financial professional that signs the back of the paycheck and not the front of the paycheck, they do not understand you. Like a bank employee, a W-2 employee in Wall Street, they do not understand what you're going through. And some of these strategies that we're going to talk about today is they are truthful, but they may not hold truth in your life. Okay? Because you are unique. Every entrepreneur is unique. They're solving problems that their clients have, but maybe it's the combination of strategy 1, 3, and 5, or 1, 4, and 6, or maybe it's the strategy of 1 and 2 with something else that exists for you. But like, I love how you're teaching your audience that there are investment opportunities beyond the traditional stocks and bonds.
Yeah,
I was just at a conference, John, on tokenization,
right.
about like how the blockchain is rapidly or exponentially coming true. There's going to be apartment buildings on the blockchain, real world assets on the blockchain.
Right.
Going to be, the stock market just made an announcement in the last week that they believe that tokenization is here sooner than later. It's like people that are craving for advice, finding alternative investments, predictable outcomes. That's what we always talk about from an investment. An investment should have a predictable outcome. If you have a predictable outcome, then you're on the right path to building generational wealth. And so I love being here. I'll start by saying this, is that the biggest expense your listeners, you and I, have in our life is taxes. It is the biggest expense. And understanding the tax code, if you neglect the tax code, you pay taxes. If you understand structure and loopholes of the tax code, you build wealth faster, because tax savings invested for the long term build zeros and commas faster than just blindly following whatever your CPA says to do on the tax side.
Got it. I'd love to hear more about that.
Yeah. I'd love to. I think you and I are going to have some question and answers, but I did, for your audience, there's two things that I'll give to your audience today. The presentation that I do today, I will give it out to anybody who wants it. And then I also wrote a white paper. It's an academic white paper on these same 6 pieces that is also available to you and your audience. But I'd love to share like just some initial thoughts, and then we can have conversation.
Okay, please.
And so again, like, taxes are the biggest expense you'll ever have. If an entrepreneur saved $20,000 annually through proper tax planning, invested that money and just got an 8% return, that is almost $1 million
Wow.
over 20 years.
Right.
And I know that some of the I know, like what you mentioned about the deals that you have helped people put in, there are many of those deals that an 8% return, you're getting a 10, 12, 14% return. And so imagine if you save $20,000 in taxes, invested that at 14%, now we're really talking about 2 to 2.2 million over 20 years. So the true cost of neglecting tax strategy is wealth. That's the truth. So let's dive into these 6. There's these 6 tax strategies are like entity structure. Are you structured correctly? Understanding what the Augusta Rule is. There's accelerated depreciation. The 4th strategy is like the family payroll or family management company. Number 5 is is strategic retirement contributions. Like, what plan are you using to lower taxes and then grow your wealth? And then 6 is what I call geographic arbitrage. It's something in my book, The One of a Kind Financial Plan. I tell people that I live what I preach. And I personally, me and my wife, have perfected what we believe is, we've perfected geographic arbitrage. And we'll talk about like Puerto Rico when we talk about that, okay? But so entity structure, and this is one that I think is a basic one, but many new entrepreneurs don't realize the impact of this. In my 30 years of being in academic work and helping people professionally, I've come to realize that like at about $150,000 of profit in your business, this is when you need to start paying attention, not just the federal and state taxes, but the self-employment tax. That's Medicare and Social Security. Those self-employment taxes are taxed at 15.3%. And if you are not structured properly, $150,000 of profit is going to be $21,068 of self-employment taxes, and that's before federal and state taxes. So the structure is to elect S-Corp status for your business. And realtors can do this. entrepreneurs who are in the tech business, financial advisors, anybody that's independent receiving 1099 income can elect this strategy. And what it is, when that income, that profit comes in, you set up a payroll for yourself that's reasonable, like a $150,000 payroll, a $60,000 or a $70,000 W-2 would be reasonable. And on that $70,000, that's what you would pay self-employment taxes on. And then everything above that self-employment is distributions. So instead of paying self-employment taxes on all 150, you only pay it on the 70. And so the tax savings, 10,358, just by proper structure.
Now, on this, as an S corporation, you always have to have a W-2. I'm thinking if you have a holding company that holds two entities, and the two entities are structured as corporations as well as the holding company, do the two sub companies have to have a W-2?
So John, what you mentioned there, like this strategy here is like tax 101.
Yeah.
Okay. What you just mentioned is like tax 501.
Okay.
It is having layering entities. So a layered entity approach or a structured entity approach
Right.
can create even further tax efficiency than this. But this is if you and I were going to go to a restaurant, right? We decided we want a steak. We could go to an Outback Steakhouse and have a steak.
Right.
Or we can go to a Michelin star restaurant and have a steak. We're having a steak, right? We're having a steak, but
Yeah.
which one are we thoroughly going to enjoy more?
Yeah. Michelin,
So
of course.
that's right. This tax strategy, what you see here is like the basics, right? This is like for somebody who is just getting into the entrepreneur world, all of the profits running through a single entity. If you want to immediately reduce taxes, right? This is a way to do it right away. If you want to go to like tax 501, layering and structuring, the way you reduce taxes is through structure, loopholes, and layering. And that, what you mentioned, is a way to take this strategy and put it on steroids.
Yeah. Love it.
Yeah. Let's go into the second strategy because the second strategy is around the Augusta Rule. Augusta, Georgia, every spring is home to a golf tournament called the Masters. And if you've never been to Augusta, I'm actually right now, I live in Puerto Rico, but I'm actually when we're doing this event, I'm actually in Scottsdale, Arizona right now at the Waste Management Open. I was at the Waste Management Open all day, came in, that's why my hair is all disheveled. But I was at the Waste Management Open. I love golf. The interesting thing about being in Scottsdale, Arizona is there's a lot of hotels and a lot of entertainment options here.
Yeah.
In Augusta, Georgia, there's nothing. You are literally in the middle of nowhere. And there's not a lot of hotels, and that's intentional. It's a small town. They want to maintain their small town. But a really popular senator from Georgia convinced the IRS to allow residents of Augusta, Georgia, to rent their homes for 2 weeks out of the year, 14 days, and that rental income be tax-free. What's interesting about residents of Augusta, Georgia, in Omaha, Nebraska, in Silicon Valley, California, in Austin, Texas, in New York City, is you're all U.S. citizens. And if it applies in Augusta, Georgia, it applies to where you are. And so you can take your home and rent your home to your business for 14 days per year. You deduct that rental to your business, and that money that's given to you personally is 100% tax-free.
Nice.
Now, the interesting part about this is imagine if you do a client event or you're going to entertain, like you're a realtor and you're going to do like maybe a first-time home buyers and 6 people and you want to bring them to your home and on your patio, just do a little event, a webinar. And you want to do that 12 times a year, once a month, and you live in Jackson, Mississippi, which is not like it's a great town to live in, Southern charm, but like a rental of a conference room at the country club's maybe $500 a day. Instead of paying that country club, do it on your patio, $500. You do it 12 days a year, and that's $6,000 of tax-free income to yourself. And that savings, if you're in the 32% marginal bracket, is $1,920. Now, if you're in Silicon Valley, California, add a zero.
Right.
If you're in
That's right.
Seattle, Washington, if you're in Los Angeles, if you're in New York City, Boston, Dallas, Houston, Miami, add a zero to that, and you start seeing where this can really add up.
Yeah.
The interesting part about this rule is you need to document it, and so you would need to find something comparable and find out what their rental rate is, document it for yourself, and then have a contract between your business and you personally that says you're renting it for what purpose. And then you have to move the money from your business to your personal account. But this strategy right here is used for 2 weeks a year in Augusta, Georgia, and thousands of residents pass tax-free income. Right? Now, this money's coming from renters, tourists. But if you own a business, you host events, you do client events, you do internal business meetings, you do masterminds, coaching, you do IT conferences. Even if you just have a client that you have dinner with, this is a way to get tax-free income out of your business.
Nice. Okay. Now, the business that you own, can it be a sole proprietorship? Like the entity structure
Yeah,
does not matter as much.
on this entity structure, it does not matter if it's a sole proprietorship, if it's an S-Corp, if it's a
Right.
C-Corp. This rule has a lot of flexibility. Because remember, in Augusta, Georgia, there's just a lot of people. Mary and Tom Smith just own their home. They've owned it for 50 years. And they didn't set up an LLC. They're just taking a check from Mercedes, right? Corporations to rent the home, right? This one has a lot of flexibility to it.
Got it. Nice.
The third strategy here is like accelerated depreciation. This in the last administration, this one kind of got reduced. Like over time, it went from 100% to 80 to 60. But with the one big beautiful bill that was passed July of 2025, I'm sorry, 2024, July 2024, this one came back in full force. And we all, for the most part, drive a car. Maybe some of us own a business where we buy equipment, right? But this is a beautiful strategy on something we do anyway. Imagine on this specific section right here, you can do up to a $2.5 million of income reduction of equipment or automobile reduction. This specific section is used by like companies that do moving, that move either like earth material, like dump trucks, or rental car agencies, exotic car agencies. But this can be
Right.
done even in a small business. So if you drive for work, so think realtors, attorneys, accountants, you own your own business. If you go to a different spot for work and driving is part of it, you could buy a car. And I walk through an example here. Let's say you bought a $90,000 Cadillac Escalade. And it doesn't have to be new. It just has to be new to you. So it could be a used car. And let's say the purchase price was $90,000. The gross vehicle weight is over 6,000. So it qualifies for Section 179 deduction plus the bonus depreciation, 100%. So a $90,000 car, you can get $90,000 of income reduction for buying something you're going to have anyway. The really fascinating part about this tax strategy is you don't even have to use cash to do this. You can get an auto loan. You can get a
Right.
small business loan for an auto. You can literally get this tax deduction to reduce taxes now, get the tax savings, and then pay that car back over 5, 6, 7 years. It's a really good strategy.
Now you said new to you. So if you, not so much as a sole proprietor, but if you had an S Corp, it's a separate entity, you have a car, can you sell the car to the entity and would
No,
that qualify? Okay.
no, because that is not new to you,
Got it. Okay.
right? You own that car before, and basically you just transferred it within
Correct.
name, but it's not new to you. You've driven that car,
Right.
you put miles on it. It has to be new to you.
Understood. Okay.
Yeah.
Got it.
We get into this fourth strategy this is about the biggest wealth building tool that exists. In people with children, people with nieces and nephews, even by the way, if you have parents who live with you. This whole concept of family family payroll and family management company. This is a strategy, by the way, that can be used by W-2 employees too. I know we're not talking to W-2 employees, but this is a strategy that can be used by W-2 employees legally. And what you do is you set up family payroll is there's a list of tasks kids can do. For instance, in California, a baby can be a social media influencer.
Sure. Yeah.
And that's not even California. That could be any state, for instance. If your regular course of business requires social media, put your kid out there holding the sign to your business or welcoming people, or maybe you have your baby, a 2-year-old, as they're learning words, like just say the name of your business and put it on social media. You could pay them. How the system works is you hire your children under 18, you hire them, and the income you pay them, currently up to $14,600, you can, through structure, go a little bit higher than $14,600 because of like employer education credits. Like employers can pay up to a certain amount for their employees to be educated, $5,600, $6,000, depending on where you are. But basic, up to the standard deduction, you pay your kid. You pay them as a 1099 employee, by the way. You don't pay them as a W-2. You pay them as 1099.
Okay.
That 1099 is exempt from Social Security and Medicare because because it's standard deduction. You give them $14,600. When they take the standard deduction, what's their income? It's zero.
Right.
It's their income. So you save that tax. But then what you do is you go when you set up like with some of that money. And by the way, that $14,600 can be used for a lot of things. It can be used to help you pay your mortgage, right? Because your kids live there. It can be used to help pay utilities. It can be used to pay a kid's car insurance. It can be used. This is money you bring out of your business tax-free that you don't pay income tax on, and it can be used. What I advocate doing, and this is where the wealth hack is, you take that $14,600 and up to the contribution limits of a Roth IRA, you contribute to the Roth IRA. Because remember, the kid now has earned income.
Right.
And they can contribute to a custodial Roth IRA. And if you do that for a child, if you put $5,000 into a custodial Roth IRA and you only fund it for age 14, 15, 16, 17, and 18, 5 years, right? A little bit more than that with some inflation, right? By age 55, that child in their Roth IRA would have over $1 million.
Wow.
And
It's powerful.
it is powerful because
Yeah.
what's true about a Roth IRA is all of that growth is tax-free. The distributions are tax-free. And just to illustrate the point, I went a little longer here. Total contributions, $25,000 up here at the top. The final balance at age 60 is $1,838,000. That is with a 10% rate of return like the S&P 500. The return multiple on cash invested, 73.6 times.
It's amazing. Yeah.
It's absolutely crazy. And all you're doing is you're saving money in your company by taxes, by just moving it from your company that you don't pay on, get it into your family, putting some of that aside for your kids, and then you can use the rest of that money that if you pay $14,600, $7,500 to your kids, or $5,000, in this case $5,000. The $9,000 rest can be used to pay family expenses, tax-free.
Yeah, the thing I like about this strategy is A, you're reducing the company profits, right? So you're going to be taxed less at the company level. And then B, you're not only paying your kids, but it's tax sheltered. And then C, you're growing their retirement income, which is fantastic.
Yeah, and the great thing about Roth, by the way, and I mean, I would never advocate to do it for this reason, but the principal amount of Roth, and by the way, the growth of Roth after 5
Right.
years, you can strip it out and use it for something.
Right.
But you wouldn't want it. Where the strategy really works, you wouldn't want to at the age of 40 take $230,000 out. But if the child really needs it, you would.
Correct.
You have that ability. The other thing is you and I both know is that Roth IRAs have become, because of self-directed IRAs, these type of vehicles can be invested in things like corporations. You could start a business with this type of money. You could, with a self-directed IRA, you could buy real estate, oil and gas. You could buy
Oh yeah,
private
that's right.
equity. There's all kind of strategies here. I've just illustrated the S&P 500 because it's the easiest to see growth. But after you get a certain balance, imagine a 35-year-old kid with 200,000 that all of a sudden that's 20 years from now. So imagine they want to go in and they want to do the next level, whatever's next after AI, whatever the next big growth engine is. And they want
Right.
to use this money to be a little more speculative in nature. That then you would have the ability, if you can get like a 30, 40, 50% return because of the amount of because of what you're doing in your business, all of a sudden you're talking about having a 15, 20, 30 million dollar Roth IRA. This is the one, like this strategy starting out right now. We used to always talk about, I've been in financial planning for 30 years. We used to always talk about you save for the next generation so they can explore to do things like try to go out and do research and development to find a cure for cancer, or so that they can be an artist, or they can choose their path. This strategy right here allows your kid to choose their investment path because capital is everything.
Yeah. Now, your illustration here is 14 to 18, but there's nothing to say that you could start from a very young age.
Let's assume I'm going to go a little bit off script here, and I
Yep.
just want to show you maybe see if I could pull up this real fast. It'd take me just a second.
Yeah, no worries.
But let's say this is a very basic compound interest calculator. It's on investor.gov. But let's say that a Roth IRA is funded with 5,000. That's basically $416 a month. Okay? And let's say you do this for a 2-year-old, so 16 years, and you get a 10% rate of return. So we're going to get an initial amount here first. So
Yeah.
at 18 years old, that money would have grown to $179,465. Now
Mhm.
let's take that number, 179,465. Let's no more contributions, and let's go out to that age 60, 42 years. Still assume the 10% rate of return. John, you're a very smart man. When I hit this red button, what is that result going to be?
Somewhere in the millions. I can't even
Okay.
guess.
Watch how big this number is.
Oh gosh, that's
That
right.
is $10 million dollars
Yeah.
for a 60-year-old. This concept of like family payroll, that when I say that this is one of the biggest tax strategies that exist out there, I am not exaggerating that concept because this family payroll system, if you're growing a business, if you're solving problems for other people and you have a kid or two or three at home, and you find yourself paying taxes, if you're making 300, 400, 500, 600, $800,000, right? 2 million, 4 million. This is when you combine this with like proper structure and maybe the Augusta Rule, all of a sudden those are great strategies to reduce taxes, and this one will do it too. But this is wealth building
Oh yeah. I
because we're
love it.
talking about tax free, right? This is huge.
And again, it's the board, you can start whenever, but you have in your model up to 18, but you really could pay them beyond that,
Oh,
correct?
oh my gosh! You want to let's go in here to this number for a second, right?
Yeah,
Remember how we didn't add anything to this?
correct.
Let's say $500 was added per month to that account.
Yeah,
$6,000 a year for 42 years. Now, watch this number.
yeah. It's
It's just
crazy.
crazy like how
Yeah,
it keeps going. And by the way, kids that are born now, their life expectancies are they're probably not going to be retired at 60, right? They're probably retired at
yeah,
80 because their life expectancies are 110.
yeah.
So let's say they don't need this money till 80, right? Now watch this.
Right.
Now we're talking about, guys, we're talking about serious generational wealth now.
Correct.
Yes, that is. So as you can tell, I'm a big advocate of this strategy. I did this personally for my kids. and I've been doing this for a while. My kids don't listen to me on podcasts, thank goodness, because if they
Yeah.
did,
That's right.
if they did, they would realize how wealthy they really are. But like my 28-year-old, when he went to college when he was 18, he had a $212,000 Roth. That was 10 years ago.
Very nice.
If you think about what's happened in the stock market over the last 10 years, he has $1 million Roth at the age of 28. My
Yeah.
24-year-old has a $600,000 Roth. And my 20-year-old, it's just timing, right? Only has like a $400,000 Roth.
Yeah.
You want to talk about building something up? And my son is an anesthesiologist. He doesn't need this money,
Right.
right? He's doing well. So this strategy is one that, by the way, guys, I should say this up front. These 6 strategies are strategies that I all personally use. I can't use as many of them now because I live in Puerto Rico, but I have used every single one of these strategies from a tax planning standpoint. This strategy here, tax strategy 5, is about, we all know we need to, as entrepreneurs, we need to pay ourselves first. This is a pay yourself first strategy. This is saving for the future. If you're a solopreneur, no employees, or part-time employees or contracted employees, if you pay yourself, you can defer. The employee can defer $24,500 if you're under 50 years old. And if you're in, and you could also contribute up to 25% of your profit. It's up to a maximum of 72,000. And if you're between 60 and 63, that number is actually 83,250. John, one of the most interesting things about this is if you're married, you can do this for you and your spouse. So if you have $1 million coming in your business and you're struggling, right, to find ways to save money and reduce taxes, and you don't need all that income, this strategy right here, $144,000 a year put aside. Give an example here. Let's say Alex is an IT executive or an IT consultant making $150,000 net income. He hasn't reached the age where he can do catch-up contributions yet,
Right.
because he's under 50, but can defer $24,500. Can take $30,000 of the net income, another 30, and do contributions of $54,500. And if Alex is in the 32% tax bracket, right? 32% tax bracket, that's
Mm-hmm.
$17,440. John, I want to go one step further with this, because some people just don't always connect the dots, right? Because a lot of people are not financially inclined with taxes. But let's say Alex is a W-2 employee for ABC software company.
Right.
And Alex contributes $24,500 to his plan at his work. But he also makes $150,000 at Alex Consulting. Alex could still set up a solo K. He cannot do the employee deferral because you cannot do the maximum. The 24,500 is the combined of deferrals. Cannot do that, but he can 100% do the profit sharing.
Oh, okay.
So you could set up a K plan, have no contributions, and still set up this 20% net.
Interesting.
So
Okay.
again, if Alex is a W-2 employee and he has contracting money, he could set that up. Now, if Alex is married, Alex could also, and Alex's spouse doesn't work, Alex can set up this solo K for employer contributions and to get money to the spouse.
I see. Okay. I was going to ask that question. How does the spouse get the contribution? But
Yeah,
you've answered it.
through
Okay.
the employer. I know you believe a lot into alternative investments. The interesting thing about a solo K is like when you do it at one of the big players like Fidelity, Charles Schwab, and the such, right, is the investments are somewhat vanilla chocolate, right, ETFs.
Right.
They have learned that they need to get into the market of some alts, right? So you can buy like IBIT for Bitcoin or silver, gold, but that's still not very exotic. So if you want to buy real estate, then you have to buy REITs. They're not really diving in deep. The interesting thing about a solo K, if it is structured right, you can roll over in-service withdrawals out of a 401k into a self-directed IRA to then go do oil and gas, apartment complexes, raw land development. You can do all that
Yep.
there. So
Yep. Love it.
remember, solo K is not an investment strategy. It's a tax strategy. Solo Ks, 401ks, IRAs, they're just tax strategies. The underlying investment is where the return is made. But you just got to make sure to not violate the tax strategy, and then the world is open from an investment standpoint.
So in this particular example, can you set up a solo K with a self-directed custodian directly, or do you have to roll?
They're not as popular. They have not gotten as popular yet. There are a couple of trustees, right? The 401k world, there's a couple parties when you set up a 401k. There's the administrator, third-party administrator, trustee. There's the custodian of the asset, and then there's the people contributing, the employee. So it's a three-way relationship. The alternative space, the self-directed space, there are some companies that are diving into this because you see that these balances can grow very big, very fast. Yeah. So there's a couple places getting into that, but the mainstream companies, Schwab, Fidelity, they have not gotten into that world of the self-directed. So that's why structuring the solo K to allow for in-service withdrawals is so critical.
So a couple questions. It's up to your income, correct?
Yeah.
So you can obviously contribute more than your income.
Correct. That's exactly right. Yeah. Yeah.
And yeah, go ahead.
So if you only have $100,000 of income, you can do this 24,500 of deferrals. So if you had less than 24,500 of income, you can't do more than what your income is. But if you had $100,000 of income, what this scenario would be like is 24,500 of deferrals and then 20,000 of employer. Okay.
Got it. I see.
Yeah.
Okay.
Yeah, because that's the percentage. The first one is a limit up to the max. And as long you can go as up to your income for that, then the 20% is a percentage of the revenue.
Understood. Okay. That makes sense.
Yeah.
And again, it does not depend on the entity structure, correct?
No, solo Ks can be set up for sole proprietorships. They can be set up for anybody.
Okay, love it.
These are becoming, they haven't become like mainstream yet, but they are finding a lot of traction in the solopreneur world. A couple keys to this is you cannot have full-time employees to have a solo K. Because then if you had full-time employees, you'd have to have a regular 401k. Okay? So you can't have employees. You can have part-time and contractors.
Okay. Yeah. So does that preclude S-Corps from having a solo 401k?
No, an S-Corp can have, like my wife's a real estate agent. She's the only employee of that business, and she had a solo K.
Okay,
right,
got it. Okay.
Before we moved to Puerto Rico.
Got it. So it is possible, which is great.
Yep.
Great to know.
Absolutely.
Okay.
And this by far and away, this last strategy is my favorite strategy. This is geographic arbitrage, and we're going to talk about this two ways. We have become a nomad society. Because of COVID, so many people work remote. And a lot of big corporations have returned to work, right? But there's so many people who have become self-employed solopreneurs, entrepreneurs who are nomads. And if you're a nomad, there are reasons to live in places like family, like your family's there, you're caring for an aging parent, the school system maybe for your kids. But this geographic arbitrage, for instance, like if you live in, I will take Reno, for instance, right? Like it's right on the border of Nevada and California. Okay? The difference between living on just maybe a quarter of a mile can be up to 9% in taxes.
Yeah.
Difference between living in Oklahoma and Texas, Georgia and Florida, Kentucky and Tennessee. That could be huge. And so when I talk about arbitrage is like that difference, the term arbitrage is that difference like between what you pay and what you get. Arbitrage. So these are the states with no income tax. So Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, Wyoming, New Hampshire. And if you're a nomad, right? And again, there's reasons to live in New York City, right? If you just love the energy and the vibrancy of being in the city, if you have family in California, if Oregon, right? If your people are in Oregon, you need to be in Oregon. Yeah. But if you have the ability to move and maybe move your family, this is the first level of geographic arbitrage. This is. Remember how we talking about with the very first thing, like there's tax 101, there's taxes 505? This is like tax 101 on geographic arbitrage. Now, My wife and I have elevated geographic arbitrage because we've moved to Puerto Rico. And I don't have a slide for this one because this is one I have to talk about
Okay.
because,
Can I ask before you launch into that, you in your last slide you have for investment income only. Could you explain that, the asterisks?
invest. So like
I understand the no income tax.
Wyoming is investment income only. That's why so many people
Oh,
tell you we forgot to put the asterisk up there.
okay.
But why? That's why there's so many Wyoming based LLCs.
Yeah.
Yeah. So that's why. Yeah. That's a good catch, by the way. Oh, I should have. You should have caught that in the green room before we got started. No, I'm joking. Joking. But yeah, my wife and I made the decision. Our youngest child is a junior in college now. And so we had decided that we were going to move overseas because I'm not 50 yet, but I will be in 2026. And I've adopted this philosophy that we all are one of a kind and you only have this one life to live and you better live it. All right. I don't buy into the theory that I need to work for 40 or 50 years and then have 10 to 12 years to enjoy the rest of my life. I want to enjoy the life I'm living now. So we had made the decision that we were going to move. We thought we were going to move to Lima, Peru. Like the culture. If you've ever been to Peru, the culture, the food, the energy, it's a beach town, right? It's
Hmm.
right on the coast.
Okay. Yep.
It's almost like New York City that is more laid back.
Oh, nice.
And the
Okay.
food is really elevated there. If you were going to like world's 50 best restaurants,
Yep.
the city
I've heard that.
the city with the most number of restaurants is Lima, Peru. And so we thought we were going to move to Lima. We also explored like Santiago, Chile,
Okay.
which we love Santiago, Chile. We just love it. And we wanted to stay in a time zone that was somewhat central in the United States because we were still going to work remotely. But then my wife is half Puerto Rican and we discovered Act 60, which is a code in Puerto Rico that allows you to, it's an import code. It allows you to import onto the island. And for entrepreneurs, you can import income. So
Oh,
if you provide services back to mainland United States, that income is produced on the mainland and you import it into Puerto Rico, it is an expense to your business. And this is where some entity structure goes into place, right? So you have to have an entity in the United States, but it's that moving the money from Virginia, in my case, my corporation in Virginia, to One Oak, Puerto Rico. It's an expense to One Oak Financial. It is income to One Oak, Puerto Rico because it's imported. So as an
hmm.
expense, I don't pay any tax because it reduces income. And in Puerto Rico, because I'm Act 60, I only pay 4% tax.
Wow.
No federal.
Oh, wow. Okay.
So where our effective tax rate was 31.6%, our state tax rate was 5.7. We paid 37.3% in total taxes. Now we pay 4.
Oh, wow.
That is arbitrage.
Yeah, that's amazing.
It is. And again, it is not right for everybody because there's some conditions to that, right? You have to live on the island for more than you live anywhere else, typically 6 months in a day.
Okay.
You have to have a closer connection to the island than you have anywhere else. If you go to church, you have to go to church there. If you go to a gym, your gym membership needs to be there. If you're volunteering your time, you need to volunteer your time there, right? Your doctors, your medical insurance needs to be in Puerto Rico. And then the third requirement is there's a number that you have to give to charities, like a dollar amount.
Got it. Okay.
Mine and my wife's tax savings in 2025, we're almost done with all the numbers. We've got some preliminary numbers, but our tax savings in 2025 look to be close to $800,000.
Oh, wow.
Yeah. Yeah. And so arbitrage or geographic arbitrage, if you're doing it from state, if you make $500,000, you move from California to Nevada, right? That's about $45,000. Almost like a no-brainer if you can afford to do it. For us, going to Puerto Rico, uprooting your life, is you have to be committed to the cause. And in the book, The One of a Kind Financial Plan, I talk about how taxes are the biggest expense you pay in your life, and I need to live it. John, the looks I get from people of when I say I'm Puerto Rican are, I'm not Puerto Rican. I live
Right,
in
right.
Puerto Rico. It's an interesting thing about being an American, right? You could be from all over the world, and if you come to America, you could be an American. But like an American cannot go to Puerto Rico and be a Puerto Rican, right? So I'm
Right.
not Puerto Rican. I just live there.
Now, is there a same type of process and benefit if you go elsewhere to another country?
So there are some exemptions. Like I have some friends who, because I've gotten to a community of people that explored this together, so we could find.
Yeah.
I've got a friend who lives in Ecuador, and he has a restriction where he can only be in the United States for 30 days per year.
Oh, wow. Okay.
Yeah, so I mean, there's some others like we know of people, we retirees that have expatted to Portugal or Central America.
That's right.
Yes, there's a lot of other ways to do this. Matter of fact, there's also a way if you have a corporation and you are not ready to move yourself to a place like Puerto Rico, or by the way, there's a couple territories we have in the United States. We have St. Thomas, Puerto Rico, America Samoa.
Okay.
People forget about that, Guam. They all have their own little tax burden or tax trick. Like America Samoa, if you're in manufacturing, if you bring product into the United States, like if that's your business, if and people that do that have been hit with tariffs, like huge tariffs. So America Samoa has a deal with the United States that that anything exported from America Samoa to the mainland has zero tariffs. So if you're in the export import business, bringing stuff in from overseas, and your business has been hurt by that, you may want to consider creating a corporation in America Samoa. And I know the treasurer of America Samoa. I know the president and I are on first name basis. That like literally we can help you set up a corporation in America Samoa where instead of your product paying some tariffs are 5,500%, instead of paying that, you'd literally move your product through American Samoa and into the United States, maybe adding like a week, but you don't pay the tariff, and
It's
that
amazing.
and that cannot be changed. And so all of the there's so much geographic arbitrage, right? Like that is out there between territories. I would tell people to first look, if you're doing geographic arbitrage, to look at state arbitrage first, territory arbitrage second, and then I would look at fully expatting third. And we don't know them all, but we know most of them in our
Hmm.
company to be able
Okay.
to. There's been a big move to Portugal. That's the one that we have seen over and over again.
Yeah, I've heard of that as well. And it seems like I don't know the details of Portugal, but it seems like it's both a lower cost country to live in,
Yes,
and it seems like it's beneficial.
quality of life is big there.
Quality of life.
Quality of life is tremendous there, and there's a lot of Americans who moved, and they've pocketed most of the time in expat when expats move to an area, they pocket together. Puerto Rico has that. Dorado and Palmas. There's American like little clusters that
Got it.
they still. It defeats the purpose, by the way, because if you're really going to move somewhere, you should experience the culture, right? You
Right.
should you should you should fully
That's
integrate.
right. That's right. I know we're about time actually, and there's probably a ton more to talk about. At some point, we'll have to bring you back to talk more about other strategies that you might have in mind. But how can investors find out more information about these strategies that you talked about and possibly get in touch with you to find out more?
You can, if you want to reach out to me directly, you just go to mikemilligan.com. So it's just my name, mikemilligan.com. I have a very simple philosophy. I like to educate, coach, and plan. And like I have a platform on school where I educate on these strategies. I coach other financial advisors, financial planners, business
Mm.
professionals on how to implement some of these. But then like the planning, we have a full service financial planning firm that implements these. It's called One Oak Financial. You could find details about that at mikemilligan.com. And then you can hit contact us or contact me there. And Jamil on my team will get you on the calendar to have more conversations.
Okay. Thank you for that. We'll include your contact information in the description of this podcast episode as well. Don't forget to like and subscribe to our podcast on whichever platform you're listening to make sure that we can continue bringing you the best educational content like this one. Thanks, everyone. Thanks, Mike. And until next time, keep learning to invest for generational wealth.